And then the last thing is deferred compensation. Deferred compensation is a way that a lot of employers pay high-paying executives for two reasons. One, it defers tax liability. Like if you can keep the income under a certain tax bracket, but you have deferred compensation so they get paid into their retirement, that could be a source of tax relief for the employee. The other benefit of deferred compensation is its incentive for the employee to stay with the company and not retire early or change jobs, because a lot of that deferred comp has to be vested. And if you're not there for the whole time for the deferred comp to be, whether it's stock or cash, to be fully vested, then the company does not have to pay that compensation, versus if they had to pay up front, the money's paid up front and they don't have the same kind of protection from attrition. And deferred comp strategies are often used to help manage the wealth of high-paid executives in a variety of different fields. A controlled foreign corporation is a foreign company, and they're usually at places like Singapore or the Cayman with very low income tax rates, where a foreign company that U.S. shareholders owning at least 10% of the company each. It doesn't have to be U.S., but this is a mostly an American audience, so I'm going to use an American example, that collectively controls more than 50% of the voting power or value. And this just applies to U.S. taxes too, which is why I'm using the U.S. as an example. They are subject to U.S. tax rules designed to prevent tax avoidance strategies through offshore entities. Before you had a lot of legislation on controlled foreign corporations, these were a very common way for the wealthy to use offshore accounts or offshore entities to avoid taxes. But as the tax authorities have gotten more aware of these kind of things, it doesn't really work as well as it used to. Different countries have different rules on this, so other countries, it might be a little bit more lenient on controlled foreign corporations. But basically, the benefits of a controlled foreign corporation for a high net worth individual is they can keep a lot of their assets overseas held through the corporation, and they pay the corporate income tax on the local jurisdiction, and they can buy all their investments through the controlled foreign corporation. They can buy certain other personal assets and make them business assets and a variety of other things as long as they are outside of U.S. borders. As soon as you bring in the assets into the U.S. or proceeds from the assets into the U.S. in the case of investments, then you have to pay U.S. taxes on the assets and or the proceeds. So in theory, the reason why you would want to do this is that you can pay the lower corporate tax in the foreign jurisdiction and not have to pay U.S. income tax until you bring the money back into the country. And if you never bring the money back into the country, you never theoretically have to pay taxes. And note, I am not a tax advisor. And I said this in the beginning of the video. Please do your own tax research or find a qualified CPA to help you. And I don't want you guys all setting up random foreign companies with the hopes of avoiding taxes. There are certain rules, though, to this because, again, it's changed. One, if it's a passive income, such as dividends, interest, and rent, given the fact that the U.S. is one of the few countries in the world where you're taxed on worldwide income, no matter where it's sourced at U.S. rates, you're still going to pay U.S. income taxes. This might be a better strategy for countries that have either territorial tax structures or tax structures where it's based on the country of residence and not solely on your citizenship. So, but for Americans, they kind of don't get the Americans don't really get privileges when it comes to that kind of thing. And then, the other thing is that when it comes to these, you can accumulate income offshore and delaying tax liability. The other things are not as popular as they used to, in addition to the IRS becoming more aware of these kind of things, is that the U.S. has slashed corporate taxes recently. Pre-2017, the U.S. had some of the highest corporate tax rates in the world, 35%. And now they're down to 21%. And there's potential tax cuts coming under the Trump administration, particularly for companies primarily make or sell their products in the United States. So the difference between the tax you pay in the foreign corporation and the tax you pay in a US corporation is a lot narrower. And because the gap is narrower, it makes this tax avoidance strategy less convenient, especially as there's other options such as private placement life insurance, which may be more efficient and effective at doing a similar thing. And also note, I don't really have any involvement in the insurance industry professionally whatsoever. Then, and also just the risk of not complying with these type of things results in really severe tax penalties because I don't really want to set the precedent of evasion through foreign companies. The next thing I'm going to talk about is dual citizenships or citizenships for purchase. Say you live in a country that's geopolitically not so stable, or you want protection in case if your country becomes less geopolitically stable. As one way to hedge yourself is through a foreign citizenship. These can be very valuable if it's in a country that has either a different geopolitical stance or has a better reputation foreign or has a stronger passport. And it allows you also to have dual citizenships, allows you to buy assets in countries that are only allowed for their citizens. So, for example, there are certain parts of Europe that only European Union citizens are allowed to buy real estate. So if you're an American citizen with no EU passport, you're out of luck. Whereas if you do have an EU passport, you can participate and own these properties. And there are many other types of those examples around the world. Or if you don't like the tax situation in your country or have a political reason to economically migrate, you can renounce your citizenship and have a new one and not end up as a stateless person. There are certain countries, mostly in the Caribbean, that you can buy citizenships. There's others, people, and get citizenship that way. And then there are others that you just have to be creative and maybe use your heritage or certain things to get citizenship. But for most ultra high net worth individuals, dual citizenships are a lot more accessible than it is to us normal folks. So that is an option that people use as insurance against their home country. The next thing I want to talk about is FATCA and exit taxes. FATCA is a policy that was passed in the wake of the financial crisis, which basically requires every foreign bank to report any U.S. citizens' holdings of their foreign assets. This is what killed the Swiss bank account, essentially. Back in the day, a lot of people would have Swiss bank accounts and use them to hide money for either asset protection reasons or for tax avoidance. But then when FATCA came along, the Swiss banks were kind of forced to comply with the U.S.'s disclosure standards. And eventually a lot of other countries are caught on. And so therefore, the secrecy part of the Swiss banking system was very compromised. And a lot of the tax havens, beneficiaries for Americans having assets in tax havens all over the world went away overnight. And that's because of FATCA. It just made a secrecy harder. And now there's international equivalents that other countries have adopted too. So there's also the exit tax. Exit taxes are for a lot of countries that have them to prevent wealthy citizens from gaining a citizenship elsewhere and not paying tax. So instead what they do is they will pass an exit tax, which the U.S. passed one in the Clinton administration in the 90s, and several other countries are considering doing similar moves. And what they do is that when you leave a country, then you have to pay a tax on all your assets, especially assuming you sell everything and pay a long-term capital gains tax rate. That's usually about what it is for most of these countries. And so as a result, you end up getting stuck with, I'm going to give some examples of major countries with exit taxes. The U.S. has an exit tax. So as I mentioned, the most notable one. U.S. or residents who've lived in the U.S. for 8 of the last 15 years have either a net worth exceeding $2 million or an average net income tax liability above a specified threshold, which is $190,000 for 2024. And if you're in one of those two categories, you have to pay an exit tax. And it's essentially an unrealized capital gains on assets if they were sold at a fair value today. So it's we're going top federal tax rate, so 23.8% exit tax. If you want to renounce your citizenship. France also is proposing one. Individuals who've been French tax residents for 6 of the last 10 years and move their domicile outside of France, those who hold either equities that exceed 50% of their net worth and or greater than 800,000 euro in value have to pay an unrealized capital gains tax upon exiting the country. It's not on all their assets, it's just publicly traded equities. Germany also has an exit tax for people who've lived in Germany for more than 10 years. It's unrealized capital gains. It can be deferred if you move to another EU country, though. So it only really applies if you leave the EU. Spain also has one for assets over 4 million euros, 25% unrealized capital gains. It has one as well. It's a similar thing. Denmark, Netherlands, Italy, and Norway. And Norway is particularly the most pernicious because they have very high capital gains tax rates, for one. And two, they have wealth taxes. So if you're over a certain net worth, you have to pay 1% of your net worth to the government every year. So it's like having a financial advisor without them actually helping you get investment returns. Yeah, you pay the fees without. But the thing is that when it comes to this, in Norway, if you don't leave and that 1% compounds every year, especially if you have to sell assets and then pay capital gains on that. So you really have to sell most of the 2% of your assets every year, or at least 1.5% to cover the capital gains on the asset you're selling to cover the wealth tax, unless you generate enough dividend income to make it work. Then you have to pay every year. So like if you're in the country for more than 30 years, your family's going to be at risk of running out of money as that keeps going. And so a lot of Norwegians are actually leaving the country and saying, forget it, I'm just going to pay the exit tax because I eventually run out of money through the wealth tax anyway. Exit taxes are kind of a pernicious thing, but they're very politically popular because the people who are renouncing their citizenship are a very small percentage of the vote, or not. And once they do renounce, they don't vote. So they don't really have much political power or influence. So they're an easy target for politicians. And there's really no advocacy group who's really representing the expat who doesn't want to pay taxes in America anymore. The last thing I'm going to talk about in this tier is Michael Green. So who is Michael Green? Michael Green is a CIO at a firm called Simplify Asset Management, and he has become famous because he has had one of the most notable arguments against passive investing. And so, like, what is his concern with a passive collapse? His thesis really breaks down into 3 points. And there's a recent article done in Institutional Investor magazine, which I think I will include in the description here if you want to go into the full story of Michael Green and this thesis. And speaking of that, I think Michael Green would actually be a great guest to appear on this channel. If you're watching this or know people who know him and would like to have him appear on the show, feel free to reach out to me. Passive investing disconnects prices from fundamentals. As passive becomes a bigger share of the investment pool, there are less active investors looking to find true fundamental value for assets. And since the flows are just everybody's monthly 401k contributions coming in and blindly buying an index, the stuff that's the biggest already names in the index are going to get disproportionately amount of capital. And the stuff that's not in the index or the smallest holders in the index are going to get disproportionately less capital. So it skews valuations, not really based on fundamentals, but more just on who's already has a bigger share of the float. They automatically buy stocks, again, in proportion to their market cap, regardless of fundamentals. This creates a reflexivity kind of in the Sorosian way, where higher prices attract more passive flows, which drive prices up. And then there's the concentration problem. There are really only 3 big passive ETF managers, BlackRock, Vanguard, and State Street, which control 40% of the stock market indirectly through their ETFs. I had a video talking about why there's no like grand conspiracy of them controlling companies, but there are other issues with this concentration apart just from what conspiracy theorists are concerned about. This reduces also the diversity in decision-making and creates corporate governance problems. And the third part of his thesis are liquidity risks. Passive strategies really don't provide a lot of liquidity during during market turmoil. Active managers usually the ones who provide liquidity because active managers are usually are more willing to buy stocks when they're cheap or falling down a lot because it seems like a good opportunity. Whereas passive, it's the reverse. they won't buy the cheap asset because it becomes a shrinking percentage of the index. And so therefore selling begets more selling and there's really no bid. So when something does have a big downward move, it's more likely to perpetuate and go deeper than it would be if there was a more balanced market between active and passive participants. And also during a sell-off, passive investors are forced sellers because if the ETF flows turn from positive to negative, and that might just happen just due to the aging of the baby boomers and less people contributing to 401ks, then no matter what if the company's earnings or fundamentals are improving, the stock still might go down just due to flows. And you can also see bid-ask spreads widen. And then the last part is volatility suppression and the self-reinforcing nature of this problem. Like passive flows dampen volatility because it rises all boats and it reduces dispersion in prices between specific stocks in the index. And it creates a perception of the stability and makes things seem like they are safer than they actually are. And if a reversal happens, then the volatility can unwind very quickly and lead to extreme dislocations in the market. So overall, it's like his argument is that passive is a ticking time bomb where everybody's just kind of doing the same thing, hoping that everybody will keep doing the same thing. And the 401k flows will just keep the party going indefinitely. And however, that anything causes this perpetual reflective motion to change, it could lead to just a broad blow up in the market as you see capital flow out of the indexes versus in them. And we've seen this example on the sector level. Like when ESG was really popular, you just saw this relentless selling of energy stocks. Even though the energy stocks seemed to make more profits and fundamentals of the companies were relatively solid, even after oil prices bottomed for a year after that, energy stocks seemed to sell off because the ESG flows were telling a lot of institutional investors and a lot of ETF passive holders, like, you need to lower your holdings in energy because it's not ESG compliant. And so that's kind of an example of how this happened on a more micro level. But what Michael Green is concerned about is that it could happen more on a macro level. And now we are at the final level, where it's like the really weird stuff that only applies to people in really niche situations. Like these are the kind of things that a lot of the advanced wealth managers do. The first one is 10b5 and Rule 144 selling. So this just applies to like executives or large shareholders, like those who own more than like 9% of a publicly traded company. They don't follow the same rules in terms of buying and selling stock that you or I would. They have a lot more restrictions, and for sound reasons, because if you have executives who tend to have more intimate knowledge of companies being able to trade freely, it can help cause a lot of unfair market distortions and increase insider trading risk, and also reduce the integrity of the capital markets. So there are rules to restrict executives for how they time purchases and sales of assets. The 10b5 is just really the rule that basically says that if you are one of these large concentrated shareholders, you have to have a pre-scripted plan of how you are going to sell your shares so that it is like either randomly distributed or you are going to sell a certain amount of shares at a fixed period of time. And there's a certain level of limits to how much that can be revised. And the reason they do this is because you don't want people selling right in front of a bad earnings report or doing purchases right before a good earnings report, or just using, again, their knowledge of the company to time their purchases or sales. And so and it's usually done by a fiduciary to help them exit out of these positions, and they don't tell the shareholder what they're doing once the plan has been sent. That's what 10b5s are. And then Rule 144 is this idea you have limitations on how much shares you can sell if you are one of these concentrated players. Like it would really set a bad precedent if companies, as soon as they IP, would basically, or after the lockup period, which is like a time where nobody's allowed to sell shares after the IPO, just dump all their shares right away, and the stock tanks as a result for that, and that causes problems with integrity of the capital markets. So there are regulations that really prevent this kind of behavior from happening, and that is what Rule 144 B selling is. It's basically saying how much can a concentrated holder sell in a given period of time. And there's two conditions. The first one is a 1% outstanding shares for the issuer, or the average weekly trading volume over the past 4 weeks on all exchanges where the stock is listed. This applies to affiliates, which are either insiders or people with large enough positions to be considered controlling, or those who are related parties to those groups. And a lot of non-affiliates might be subjected to volume restrictions as well if they've held the stock for more than a year. That is what the rule is that you cannot sell either 1% of the value of the company or the average trading volume of the past 4 weeks on all exchanges where it's listed. And the reason why they do this is they just don't want concentrated shareholders to dump shares. And it's also why you see a lot of people who are trying to get rid of their stock to be aggressive in promoting trading activity, because the more trading activity is, the higher the volume is, which means the more you're allowed to sell under 101.44. So that is another kind of thing to watch out for, wealth management. Network access is a perk that a lot of the larger wealth managers can offer that smaller wealth managers or people can't get themselves. And it's the idea that if you are a big wealth manager, one of the perks you might offer, in addition to the investment services that you provide and or banking needs, is access to your network. Maybe since you have such a diverse pool of like ultra high net worth individuals as your clients, or your clients are friends with certain people in high places, you could leverage that network to help your clients, whether it's to be able to reach out to people for business reasons or political purposes or who knows what, or maybe access to like get into a competitive elementary school in New York. Whatever the reason is, like the network effect built from having a large group of ultra high net worth or well-connected clients, you can connect the people who don't may know each other, but can use each other's help and offer that as a perk for your business. Yeah. The next one is the great taking. I did a whole video about it, but it's the idea that a lot of assets that you think are safe under a custodian may not be so safe, and that the whole investment industry and the global capital markets are not really prepared for such an outcome. And there's an interesting book written by David Rogers Webb, which goes into the details about this. If you want to know more about that, watch my video on the great taking. And then the next, second to last one is no one is prepared for the bear, which really means that nobody is really sufficiently prepared for a bear market, even professional advisors. There are some professional advisors who are willing to stick their nose out and hedge, either with the options market or being more defensive than the rest of the wealth advisors out there or the index, or even some like hedge fund managers are outright short. But oftentimes you can't do this sustainably because of career risk. Like that kind of defensiveness in the short term can lead to underperformance. And because of that, a lot of your clients may not stick around because they're like, oh, you're not getting as much returns as either the index or these other advisors who are willing to take more risk. And so because of these types of career risk incentive, and a lot of institutional investors are more skewed to taking on more risk or risk in line with the index so that they do not get left behind. And so as a result, positioning never tends to be defensive enough when it's most needed to be defensive. And as a result, nobody's really prepared for the bear market. And I think part of something you should look for when you do find an advisor is one who is willing to be prepared for the bear market, even if it may hurt their firm's financial success in the short term doing so, because that's really what you pay the advisors to do, is being willing to turn before the crowd does. And usually, like by the time your typical advisor is concerned about the bear, we're already in the middle, if not the end of the bear market, and that's not the time to be worried about the bear anymore. So, yeah, and that's generally no one's prepared for the bear. And the last several years of really having only one real bear market that wasn't very long, 2022, since you've had almost a generation of very little downside price volatility, which has made people even less prepared for the bear. And then the last one is advisors cannot advance your social class, but really maintain it. So like you're not going to get rich from managing money or from your stock portfolio, unless if maybe you do it for a living and start a hedge fund, you get rich that way. Or if you just are a really good stock picker and find just a lot of high quality investments, you might be able to, but again, you're doing that on a professional level because that requires professional level diligence to do that kind of trading performance in the long run. So those who are hoping to hire a wealth manager to advance them up a social class are going to be sorely disappointed. Really, what they do is they help you maintain your social class. They help you create some of these wealth trust structures that help prevent your heirs from squandering the fortune. They help invest in a prudent and fiduciary manner that helps you have returns that allow you to catch up with inflation and more so you can maintain your social class throughout your life. That is what you hire an advisor to do. Or your goals, if an individual investor, you want to do this yourself, your goal as an individual investor is to maintain your class standing. Maybe get a slight improvement of your living standards, but probably not enough that you're going to move up a class solely just through a long-term investment plan, especially if you're starting with a relatively small amount of capital. Overall, this is the iceberg of wealth management. What do you think? Let me know if you want me to do another one of these icebergs. Let me know if you have any specific questions about any of the topics I talked about in any of these chapters. And if you want to contact me directly, feel free to reach out to me via email or the contact form. I had fun doing this one, and thank you for watching. Just as a disclosure, I am the partner at a wealth management firm called Spearhead Advisors, and nothing in this is investment advice or any promises for better returns. I am not a tax advisor, and I'm not an estate attorney. So if you do not use this iceberg as advice about how to optimize your taxes or your estate planning needs. If you have any specific questions about anything involving wealth management, feel free to contact me directly, either via email or through the contact form in the pinned comment or the description, or through my website, nickpardini.com.